So having understood the budgetary control and reporting system, so let's understand the different types of budgets. So the budgets are normally classified on the following basis, that is the time period based on the conditions, capacity and coverage. So based on the time period, if you look into, so we have long-term budgets and the short-term budgets. Based on the conditions, we say it's a basic budget and the current budget. Capacity, so depending upon the production capacity, whether you want to increase the production capacity or you want to scale down uh, to lower capacity, so again we say it's a fixed budget and the flexible budget. And finally, based on coverage, so what is the coverage, whether all the different departments are going to prepare the different budgets, or it is going to comprehensively it's for the entire organization. So based on that, we say it's a functional budget and master budget. So let's look into one by one. So when we speak about the time period, so we say it's a long-term budget and the short-term budget. So this long-term and short-term budget is from the perspective of the timeline. Some organizations may prepare a budget for more than a year or so. So where they try to anticipate the business conditions are going to remain the same, where there will be no volatility, and they ensure that they have a proper, they can forecast for a very long duration of time. In such a scenario, they may go for what is known as the long-term budgets. So the budgets which are prepared for a period more than a year, we normally call them as the long-term budgets. And this kind of budgets are very much useful in business forecasting and forward planning, especially in terms of capital expenditure budgets and R&D budgets, where the R&D research activity may be prolonging for more than a year or so. Then obviously you need to spend a lot of money on those kind of activities. So in that case, they prepare what is known as the long-term budgets. In case of short-term budgets, budgets which are prepared for a period less than a year, we call them as the short-term budgets. So these budgets may run into a 1 month budget or quarterly budgets or 6 month budget. So depending upon the time frame and the requirement. So these kind of budgets are prepared in cases where specific action has to be immediately taken to bring any variation under controls. So one of the best example for short-term budgets is preparing the cash budget. So cash budget will help to control a lot of activities which are in the short term in nature. Then we have basic budget and current budget. So the basic budget is basically mean whenever the things are not going to alter over a long period of time, wherein we keep normally same things in our budget preparation, then we call that kind of a budget as a basic budget. So a current budget is basically a budget which is established for use over a short period of time, and it is related to current conditions, which means as and when the things are going to change, we require some amount of changes to be made in your budget requirements, so you go forward zone as a current budget. So based on coverage, we say it's a functional budget and master budget. So budgets which relate to the individual functions in an organizations are known as functional budget. So a purchase budget, normally a procurement department may be asked to come up with a purchase budget. So sales department may be preparing a sales budget. Production department may be asked to come up with a production budget. Like this for different functional department, if they prepare the budgets, so depending upon their functional requirement, so the budgets are going to be prepared for a given period. So we call them as a functional budget. Whereas a master budget is the one which is going to consolidate all the budgets prepared by the different functional departments, and through that the organization will come to know what is the overall amount of funds that are required to perform or to be required to be allocated during that particular period. And this will serve as a basis for preparing what is known as a budgeted profit and loss account, and forecasted balance sheets are going to be built up using this particular functional budgets. Then we have something very interesting that's called as a fixed budget and flexible budget. So this fixed budget, flexible budget is prepared considering your production capacities. For example, if the presently company is preparing is undertaking a production capacity with around 50% capacity, and throughout the year the company just maintain the same level 50% capacity irrespective of the market conditions as or so, then they normally go for what is known as a fixed budget kind of a thing. So in case if the production activities keeps fluctuating, so in a particular first quarter the production capacity the company may be using around 30%, and if it is going to be a seasonal kind of a thing, the next quarter is going to be season period, then company need to expand its production capacity. So accordingly, when the production capacity utilization changes, the company will accordingly need to accommodate the requirement. So in such a case, they try to go for what is known as a flexible budget. Even when the company is planning for some kind of enhancing the production capacity or reducing the production capacity, so which are the various costs that need to be uh, changed or which get changed as the level of activity changes. So in that case, again we go for preparing what is known as a flexible budget. So some point of difference between the fixed budget and flexible budgets have been mentioned. So based on their nature, like based on the rigidity conditions, level of activity, so whether can we do some variance analysis, and how it is going to be used for decision making purpose, and finally how we are going to do performance evaluation using these two different kinds of a budget. So let's first understand only from the fixed budget perspective, and as the definition goes, it's a budget designed to remain unchanged irrespective of the level of activity actually attained. So whether even though if we are working at 50% capacity, whether we actually use that completely 50% capacity or less than that doesn't matter. So this particular budget is going to be remaining same. When it comes to rigidity, it does not change with the actual volume of activity achieved, thus it is known as a rigid or inflexible budgets. When it comes to level of activity, it operates on one level of activity and under one set of conditions. It assumes that there will be no change in the prevailing conditions, which is unrealistic. Normally, this kind of situation to prevail is very rare case, but still in the given scenario where this kind of situation is going to prevail, then how the budget is going to be prepared, that is what we need to understand. So when we want to conduct any variance analysis, so the variance analysis does not give a useful information, as all cost, whether it's a fixed, variable and semi variables, are related only to the one level of activities. So how about the decision making process? It says if the budgeted and the actual activity differ significantly, then aspect like cost ascertainment and price fixation does not give any correct picture. And when it comes to performance evaluation, the comparison of actual performance with the budgeted target will be meaningless. So because whenever there is a difference between the two activity levels is significant, so at that time again comparing that activity with the fixed budget criteria is not going to give any realistic view. On the other hand, if you look from the flexible budget perspective, it says it's a budget which recognizing the difference between the fixed, semi-variable and variable cost, designed to change in relation to the level of activity attained. Which means under the flexible budget, when we are preparing, we first try to differentiate or we try to classify the cost into fixed cost, semi-variable cost and variable cost, and depending upon the level of activity, which costs are going to remain same and how the other costs are going to behave. So based on that we formulate the budget. Next, since from the rigidity perspective, since we are going to recast the cost, so hence the level of activity as it changes, the cost is also going to behave accordingly. When we speak on the level of activity, it consists of various budgets for different level of activity. So at 30% capacity, what will be the how the budget looks, at 50% capacity how it looks, like this. At the different level of activity we are going to have different budget altogether. Similarly, if you are manufacturing 10,000 units, what is the budget for that? If 15,000 units you are manufacturing, how the budget looks, like this, depending upon the level of activity, whether it may be units or the percentage capacity utilization, the budget is going to vary. Variance analysis provides a useful information as each cost is analyzed according to its behavior. So this is another interesting point that we can note down in the flexible budget. When it comes to decision making, it facilitates the ascertainment of the cost, fixation of selling price, and submission of quotations. Especially this is very important when we are getting an order. For example, presently the company is manufacturing just around 10,000 units. And assume if a company gets suddenly an order for 50,000 units, so because the product happens to be widely demanded in the market, so at 50,000 capacity, what happens? 50,000 units, what happens? So what should the selling price that the firm is supposed to quote? So in order to understand this, so using flexible budget, we can easily go ahead. It provides a meaningful basis for comparison of the actual performance with the budgeted targets. The next type of budget is zero based budgeting. So this concept is many of the companies are quite off late after 2000 or so. So companies have started using this concept called as zero based budgeting. But in the Indian context, it is not so popular. But in the other developed countries or so, so this concept is gaining a lot of importance. So what is zero based budgeting? As the name suggests, zero based budgeting is whenever you want to prepare a budget, normally what we do is we use last period or last quarter or last year's budget detail as a basis, and we try to add or delete some of the items and we formulate a budget for the next period. But under the zero based budgeting, it is not so. So it is, as the statement goes, many of the organization, they when they thought of rebuilding the company budget from the scratch, for them it is going to be kind of a nightmare. Which means if we ask if the companies start preparing budget every year from the zero, in the sense fresh, we're not going to consider anything as a basis of last period, but we need to start with a fresh, then it is not going to be an easy task for them. So this concept has started gaining prominence from 2008 onwards, where in an increasing number of organizations they started choosing this zero-based budgeting, because during that particular time most of the organizations had really hit with the economic recessions, so they wanted to come out from that particular what do you call recession period, and they wanted to control the cost, so they were trying to find out some ways of doing so. So hence both public and private companies, they started extremely moving towards what is known as the zero based budgeting concept. So this particular concept was developed by Peter A. Perex at Texas Instruments, and according to the author, so he says a zero based budgeting is an operating, planning and budgeting process which requires each manager to justify his entire budget request in detail from scratch, and shift the burden of proof to each manager to justify why he should spend any money at all. In a simple language, uh, normally whenever we prepare a budget, we think like this much amount of money is allocated for us, hence we are supposed to spend for that. But under zero based budgeting, so every time when the manager make a requisition for funds, he need to justify as to why this much amount of money need to be spent on a given activity, how much it is going to add value to the firm. So it is not about cutting down on the cost, but utilizing the available resource in a most productive way, so that it is going to add value to the firm. So the entire shift, most of people have this myth like zero based budgeting means it is about cutting down on a cost, but it is not about cutting down on the cost, but utilizing the resources for the most productive ways as so. And hence each whenever the budget is going to be prepared by managers, so for each and every item they need to justify as to why x amount of business to be spent for that particular activity, and how that activity is going to add a value. So zero based budgeting process, it allocates the funding based on program efficiency and necessity rather than budget history. So when this being the case, now it is going to be a very challenging task for the managers, because until now they were just preparing a budget with based on whatever the items were already prepared last in the previous period. They to just bring up all those items in the coming budgets, and they used to add just plus and minus depending upon the inflation factors, and hence they used to come up with a budget. But now it is not going to be so. So under the traditional budgeting, what is to happen, most of the items which are already there in the previous budget, they used to find a place in the upcoming budget. But now this practice is going to be completely ruled down in zero based budgeting. So hence in the zero based budgeting, the budgeters review every program and expenditure at the beginning of each budget cycle, and they must justify each line item in order to receive the funding. So this particular concept of zero based budgeting is applicable to any kind of activity, whether it is for a capital expenditure activity, whether it is purchasing of a plant and machineries, or going for any kind of big advertisement expenditures, or if you want to go for what you call operating expenses, if you want to incur any operating expenses, so sales, general and administrative cost. So you take any activity for that matter. So this zero based budgeting is very much applicable to all these segments. So some of the advantage of this zero based budgeting, if you look into, on one side, this practice of justifying each and every item will really help the managers to really think across, and they try to look into, is it really necessary that X amount of rupees to be spending, or can we cut down from X to X minus 1, and then without compromising on the quality of the activity and are trying to achieve the objectives, can we go ahead. So when you look from the advantage here, so whenever the budgets are prepared using zero based budgeting, the resultant budget is going to be well justified, and it is going to be aligned to the strategy of the company. So it's also going to help as a catalyzer in terms of broader collaboration across the organization, because it is not just a one department which is going to work in isolation. It has to coordinate and collaborate with the other departments also, so that it is going to achieve not just its own objectives in the process. It is going to take the help of other department, and it is going to what you call achieve the objectives as a whole. Support cost reduction by avoiding automatic budget increase, which often results into saving, and hence what is the amount is being saved by this particular process, that amount can be utilized for some better activities. It also helps in improving the operational efficiency by rigorously challenging the assumptions. So one side, these are the advantages that zero based budgeting is going to provide, but on the other side there are also certain disadvantages if we look from the if you look into. So the first and foremost is it is one of the costly affairs. It is a costly, complex and time consuming, because the people are presently, the most of the managers or the departmental heads, they are mostly used to this traditional uh, budgeting preparation mode, and all of a sudden when the manager need to shift from this method to the more structured and justifiable mode, though it is going to take a lot of time. So it is going to be a costly, complex and time consuming process. Next, it may be cost prohibitive for certain organizations with limited funding. It means when this organization they themselves have a small amount of money to spend for, and for those kind of organization, if this practice has been introduced, it is going to be, again it is going to be a problematic. The reason being, because they have very few things to spend for, and justifying on those few things which are more or less required to spend may be again a costly affair. It is going to be risky when the potential savings are uncertain. So no doubt on one side we are spending a lot of time and energy in preparing this zero based budgeting. On the other side, if the things goes slightly uh, what do you call against the thinking process, then it may leads into again a reverse case. Execution challenged by the budget cycle timing constraints. So by the time the budget cycle is prepared, and if there's any delay in terms of preparing the zero based budgeting and its execution, then we may miss out a great opportunities as such. It typically requires specialized training or personals to accomplish, and require more resources in general, because when you're preparing a zero based budget, you require a lot of information. You need to really go into the details of each and every activity that we'll be planning, and hence the people who are supposed to be working on zero based budgeting, they need to be completely specialized people, and they also have enough training for doing that particular activity. So this may disrupt to the organizational operations, because when people want to shift from something new, so a resistance may come in the minds of people, and this may hampers some of the like the morale of the organizations, could harm organization culture or a brand. So against this some of this background, so we have an article if you look into, where it speaks about a zero based budgeting, how to do it right. And as the title goes, basing zero based budgeting on cost cutting is the wrong approach. Okay, this article has appeared on October 29th, 2018, wherein the author says that many a time it is felt like whenever we are adopting zero based budgeting, so we feel like it is basically meant for cost cutting activities, but it is not so. So in one of the sentences in the article, it says, as margin tightens in industry after industry, more companies are talking about zero-based budgeting. The deceptively simple idea that each year budget should start from zero base rather than from prior year spending. And further, if you look into this article, it says the trouble is that often companies see zero based budgeting as just about cost control. In fact, when done right, zero based budgeting changes a company's entire culture, instilling a return on investment mentally, where people throughout the company think about value, not just the cost. So, which means, so how we actually introduces zero based budgeting, so that is more important. If we look only from the point of it is used as a cost cutting tool, then it is not going to serve the purpose. But if it is looked from a different perspective, then obviously it is going to help the organization in yielding a lot of benefits. So one of the survey that has been done by this particular company, by the author, sorry, he says uh, only out of 238 companies, only 41 of the 238 companies were able to grow when this particular zero based budgeting was introduced during the period from 2003 to 2014. So, in a 12 years survey that was undertaken by conducting research for 238 companies, it was found like only 17% were able to grow during the same time, whereas the rest experience was all pain with no lasting gain in return. Which means many a time when people start using this one, they want to get the result in a faster manner, but it may be not so. Some may get the returns at slightly later stage, but some companies may get the return in the very first year after introduction. So it's all about the how best you are going to use zero based budgeting in getting the benefits as such. So the next important topic is again on the cash budget. So this particular cash budget is very important for the organization, because cash being one of the important resources for almost all the activities. So preparing the cash budget is going to help the organization to foresee themselves as to whether they'll be having a surplus cash or a deficit cash, and accordingly they can plan for the various cash management strategies. So cash budget, when you're preparing, it is going to represent what are our anticipated receipts and payment during a budgeted period. For example, if I'm preparing a budget for the next 3 months cash budget, so I need to understand what are my anticipated cash inflows and outflows during the next 3 months time. So this cash budget is also called as a functional budget, and it's also one of the most important of all the functional budgets as such. And this particular cash budget is prepared on the basis of receipts and receipts and cash payment. So this sentence is very important. So you're going to consider only what are cash receipts and what are cash payment during the budgeted period, and through that we will try to prepare this particular cash budget. So some of the component of cash receipts and cash payment while preparing cash budget are, So we receive cash on account of sales. So this sales is categorized into cash sales and credit sales. So by selling through cash sales, the money is received in a during the same period, whereas the credit sales may take place in one period, but the collection from the credit sales may be received in some other period. So this is the most important item in cash budget. Next comes collection from debtors, that is on account of credit sales. Then comes bills receivable. So we might have received a lot of bills from our debtors. So which bill is going to be maturing on in during which particular period? So through based on that, we'll come to know whether that particular amount will be receivable in a budgeted period or not. Interest received. Normally companies will be doing a lot of investment activities, and due to this the company will be receiving interest. So during which particular period the interest is going to be received, that also need to be captured. Income from sale of investment. So when the company is planning to sell any of their what you call investments, because sometimes company will hang some policies to liquidate a certain amount of investment in a particular period. So on account of selling those investment also, are they receiving the money? Then commission received, dividend received. So these are some of the items of the cash receipts, but all these items may be not falling in the same given period, like in a particular month or so. It may be in different time period. These items may be appearing. So we need to understand only during the budgeted period which are the cash receipts which are going to occur. We need to consider only those things. On the payment side, we again come across payment on account of a purchase of goods, payment to creditors in case if we purchase the goods on credit basis, then obviously we'll be getting a credit facility, and in which we may get like 1 month credit, 2 months credit, or 15 days credit. So accordingly, if it is going to fall during the budgeted period, we need to capture that one. Payment of wages, again it's interesting. So normally the company may hang a policy to pay wages once in fortnight or every month, or it may be like every week or so. So depending upon what kind of payment of wages policy the organization has framed, so we need to consider that. Payment related to production expenses, payment related to office and administrative expenses, payment related to selling and distribution, any payment related to revenue and capital expenditures. So in case of if a company has taken up a decision like to purchase plant and machine in a particular period, so on account of purchase activity, what is the amount of capital outlay so company is going to do? Even though the plant and machine will be bought at 5 lakh rupees worth, but out of 5 lakh rupees worth plant and machinery, if 1 lakh is going to be paid in a particular time of delivery, and the remaining amount is going to spread in next 1 lakh for next 4 months time, then accordingly it may be form of installment payment. So depending upon what is the modalities of payment, we need to capture that one. Finally, the income tax, any amount of income tax payables or dividend payables, if it is there, so accordingly that becomes a part of your cash payments. So these cash receipts and cash payments are the very important items of your cash budget. So by considering this, we will be preparing a cash budget, and with the help of cash budget we will come to know what is whether the firm is going to have any surplus or any deficit amount left. In case if there is a deficit amount in a particular month, then company can always plan for going for any short-term arrangement of cash in the form of order facility or cash credit facility, or by taking short-term loans, the company can cover up the cash deficit. And in case the company is having any cash surplus, so it can always plan to invest that surplus funds in money market instruments. So depending upon for what time period they can what you call sacrifice, or they can part with their surplus funds. So this is one small example to understand how the cash budget is prepared. So this particular example, with the help of this particular problem, I'll be showing you how cash budget is going to be prepared. So this we are going to take up in the next presentation, where we are going to solve this problem on preparation of a cash budget. So this is the entire coverage with regarding to this particular module, that is budget and budgetary controls. So thank you one and all.